I'm going to tell you the way I met Amanda is on a Facebook real estate group, and someone in the group had said, man, I need a real lender, not one of you fake brokers out there. I need a lender who says they can close me a loan in, I don't know what he said, 3 days or something crazy. And Amanda said, here's my information. So I messaged her and said, hey, if you can really do this, I got a deal I need help with. And she indeed sent me everything. And that deal didn't work out, but not because of them, because my property was rural and not everyone will lend on that. But so I had such a good experience with her that when I needed my next loan, which was about 2 weeks ago, I went to her, and indeed from about the day I contacted her to the day I closed was like 2 weeks. So I cannot highly recommend her enough. I, like a lot of you, get a lot of loans, and I can tell you it is the best and easiest loan I ever got. So I said, hey, Amanda, why don't you come talk to our members? So without further ado, I'm going to turn it over to Amanda.
Awesome. Yay. I love that story too. It was a big triumphant loan and everything. So I was so glad that we got to work together on that. Hi, everybody. I'm Amanda Hart. I'm going to just be breaking down some hard money and kind of letting you know a little bit about me, answering some questions, letting you know from the lender side what we kind of look for, just kind of break down some details about different types of loans that we offer, that hard money lenders offer, and set you up for success, because I know this is kind of a different realm. And if you're just getting into investing in, as a first timer in particular, there's no reason why you would ever know about hard money or why you would need it. So we're going to talk about that because it's extremely useful for your capital purposes and accomplishing some projects. What I'll do is I'm going to go in little sections. I'm going to pause in between the sections to answer questions. So I love questions. I love answering them. I love saying things in more than one way to help everybody. So we will pause throughout for those. My first question is in the comment section. If everybody could just take 2 seconds to let me know if they've ever heard of hard money, if they have any experience with hard money, or what they just know in the ethers of like what hard money could possibly be. If you could write that in there, I'd love to see that really quick. Let's see here.
Yes, but no experience. Heard of it, heard a lot about it, not sure what it is. Yes, I'm aware, no experience. No experience. Yes, I listen to lots of
podcasts.
So it looks like most people are familiar with the term, but do not have experience with it. A couple of people do have experience with it. Some have no experience at all. But I would say not sure what it is. Heard a lot about it. Overall, it looks like most people know what it is, but don't have any real world experience with it.
Okay, perfect. I'm so bad with the chat. I've been on Zoom meetings where whoever's talking is like a pro and they're like go into the chat and they're like so in it. And I'm like, oh, I'm not that cool yet. So I appreciate everybody.
To be the speaker and do the chat. So that's why we always try to read them for you.
Thank you so much. Okay, perfect. Then I'm not going to check it when we do questions. I'll have you guys feed them out. That's amazing. So I have, luckily, I think this is actually extremely beneficial, especially working with first timers. I have a background in conventional lending. So I worked for a lender that we did conventional, FHA, VA, these last couple of years, we did a lot of refinances with the rate drop. And that is what we're all used to. We're used to the conventional loan, whether there's down payment assistance programs or whatever, we have this whole idea of either the experience we've had ourselves purchasing our homes that we own, or our friends purchasing their homes, or this, that, and the other. And you got to turn in those pay stubs, and you got to get sometimes your taxes thrown in if you're, a 1099. If you switch from W-2 to 1099 in the last year or two, you can't do anything. You're at a stand, you're just frozen for like a year. If your debt to income is over 45%, you know, if your credit score is under 700, there's so many hoops, and that's just to pre-qualify. So like, and I know it's annoying as the borrower, so it's annoying as the loan originator too. So we're used to that, okay? But hard money is very different. And when I moved into this industry, it was just like a veil being lifted. It took me a while to get into the industry because I was like, is this illegal? Because it was like way too easy. I'm like, I don't care about someone's debt to income ratio when they have to pay me back. I don't have to ask for pay stubs. I'm so confused right now. So it took me a little bit to see the benefit of it. And I wish I had gotten to this industry sooner because it is so gratifying and so easy. And I'm working, my favorite part is that I work with investors, and investors are like, let's go. And I'm like, let's go. And title's like, let's go. And everybody's just going. So it works out really great. Now, hard money is great for two reasons. One, I'm sure you've heard it, like non-qualifying. Okay. And I always feel like that like sounds kind of bad. Like, oh, you don't qualify, it's non-qualifying. But I remind you, even if you did qualify for a conventional loan, hard money is just easier, and it's faster, and it's not as like grab you by the throat and drag you through the trenches. And it's not as time consuming or as financially consuming. You're not gonna have as many closing costs and such. So basically, the reason it's beneficial is we don't ask for taxes. We don't care about your debt to income ratio. You know, I can only, when I speak about these things, I can only speak to how my company works, but I know a lot of us have very similar ways of structuring, which are what I'll point out. But a lot of companies, including mine, don't even do an appraisal. So that's why I, could close Kathy's loan so quickly. Which means you don't have to pay for an appraisal. So that saves you money right there. You don't have to put those things in. I'm more concerned about the project, and I want you to make money. It's almost like using a lender is a great buffer to know if you're getting into a good deal, because if the lender says no, you're probably dodging a bullet and should move on to the next one. Whereas if we're like, yeah, man, we'll give you money, then it's a good, like, okay, cool. This is looking really good. And you're probably in a good project and you're going to turn a good profit. So, I've heard some people say, oh, I don't want to be in a loan. I don't want to owe anybody. I'm like, okay, well, sometimes that's understandable. Like I can vibe with that. But if you are into my loan and doing draws, because a lot of hard money lenders are going to finance your rehab as well, and you're drawing on that and you're moving along, instead of using all your money to do this project, you're just like paying interest only loan, like payments every month. And then you get to the end, you sell or you refi to rent, and then that pays it off, and then you get to profit. And if you had all your money tied up into this one project, you can only do one at a time. Now, obviously, as a new timer, you're probably not going to do 6 at a time, but you eventually want to get there. And by utilizing a hard money lender, you're allowing all your money to go into where it can work for you the most, instead of just one project. So that's the main reason I think it's beneficial. And it is just easier than a conventional loan, and it's shorter term and everything. So yeah, so I kind of want to segue into what a lender looks for, which would be what you guys want to be presenting and looking for as well to get that backing. I will pause right now just to see if there's any questions really quick about just what I mentioned before moving into those more specific details.
Amanda, while they're thinking about if they're going to type any questions, I don't, if you're going to cover this later, just tell me. I'll move on. At some point, I know from the answers in the chat, the perception for hard money is that the rates are higher. And I know that's often true, but is there some hard money that is not at a higher rate? If you're going to address that later, you can save it.
Yeah, I might have gotten there, but I'm definitely going to point that down on the quotes higher rates and why it's just kind of a different ball game and why that is and whatnot compared to conventional lending. So I know, because you're like, wait, I can get 2.99, but so I'll get into that.
All right, so we do have a question from Dawn Breza, which is, how do you assess a project? Like, I guess if you're not doing appraisals, how do you assess?
Okay, so we are going to do comp comparisons. Okay, so just like you as an investor, you're like, okay, how much can I get for this when I'm done? You know, what are the comps looking like for a finished project that I can profit out on this? We're going to look at that. And this kind of segues into what I'll be talking about next, but we look for properties that have been sold in the last, especially in this market because it's so special, in the last 6 months to a year within a mile of the property. So as long as we have those supporting sales, no one really does the square foot thing. I sometimes I have investors say, oh, this is 250 square foot. I'm like, yeah, I want to know what things sold for. That's how we assess it. And we just make sure that you have a couple properties that back your ARV so that we can say, okay. And sometimes we say, hey, actually, we think you can get more for it. Or actually you're coming, like maybe you're shooting too high and we think this is come in a little more conservative. But that's how we put the ARV on the term sheet. Not having appraisals is nice, not just because of the time and the money, but if a lender, and this can just happen, you know, but if a lender says, okay, we just talked for an hour and we assessed everything and we put this ARV and now we're going to order our appraisal. If that appraisal comes back lower than that initial assessment of the ARV, your terms will change based on that appraisal. So by us coming in and setting that down, it takes us about a day or two to assess the comps in that area and look at the project as a whole. You don't have to worry about your terms changing because they just stick and we just hold it.
And so bottom line for that, y'all, when you submit to get one of these loans, do a good job on your comps because they're going to look at those and they're going to double check them. All right, so the next question is from Sheila Hatcher, and she's asking, why not rural and what do you consider rural? Now, Sheila, before Amanda answers, let me say, I think I might have said that wrong. I think actually maybe they do rural. And that's actually why I went with them, because I couldn't find anyone else to do it. But the problem with mine was they couldn't find good comps nearby. Is that right, Amanda? So, all right. So I misspoke. I apologize. So I'll let Amanda go ahead and answer that question. So and that's do rural.
Yeah. So basically, that's one of the things I like. There's a few topics that are extremely helpful if you're a first timer, because obviously it's a no-brainer. You're trying to buy low, sell high. You're trying to get that property that just is like not cutting it in the neighborhood so that you have that margin to make a profit. The things that we look for in terms of location and the property. So this is part of like our risk assessment, right? Us deciding terms, which will then segue me into like rates and stuff like that. And, you know, the usual closing costs you can expect. We look at your experience. And even though that's not a make or break it, it's just if we have a range in our rate, if you're newer and we've never done a loan with you before, instead of getting the absolute best rate, you might get like 1% higher or something like that, but you'd still get approved. We look at where the home is located. So you don't need to be in like, I'm in Dallas, so I'll just use Dallas as an example. You don't need to be like in Plano proper in Dallas, because those markets are a little cutthroat. But we also need there to be more human beings around your house than horses, you know? So
that was the problem with mine. There's more horses than humans.
More horses than humans, yeah. So because we want to make sure that you can sell your property or rent your property, which means it needs to be like inland, like in with the peoples.
Okay, next question from Dawn Brezit. Does this work for commercial as well?
So commercial lending is completely different than hard money lending. And I always try to keep a couple commercial lenders actually on speed dial, just because we don't compete with each other. And it's always nice to have someone trusted that you can refer someone to. but things like land, mobile homes, hotels, manufactured housing, stuff like that, that's going to fall more into in a commercial realm than hard money. Now, if you say, Amanda, I'm buying an acre and building a house, I will do that all day long. That's a build loan. I can do that. But if you're like, I just want the land, I can't do that. So, you know, it's a little different. The other, before I forget, the other thing to touch on is like flood and fire damage. Totally okay, but not if it's like excessive. And as a first timer, you probably don't want to get yourself into that anyway. But you know, looking at homes that have that history, just always, if you're presenting that to a lender, be like, hey, I know it's halfway burnt down, but I talked to my contractor and we set this plan up. I'm not shooting from the hip. I have a plan and it's hardcore and like good to go. Then we go, oh, okay, cool. Then yeah, we'll look at it. We're okay with that.
Okay, so the next question is from Rashida O'Neill. Do you have to have a license to broker loans in North Carolina?
So, well, I'm not a broker myself. I'm not quite sure what, and I wasn't a broker when I was conventional either. And it is different from state to state. So that's not a question I can really speak to.
I can, you do have to have a license if you are providing residential loans. That is one of the main differences in the kind of loans Amanda's talking about. They are not residential. In fact, part of the closing, generally, when you get a hard money loan, is you have to sign something certifying that I'm not using this house to live in. If you are going to move in this house, Amanda could not make you this loan.
That is mortgage fraud.
Yeah, it's got to be an investment property. So you have to have a license if you are going to live in that home to make a mortgage for it. If you are an investment property, which is the only kind of loans Amanda makes, they do not need a license. Okay, yeah. So April Williams, what's the typical turnaround time for approval?
Speaking to what I can do, I usually take 24 hours to get that to you.
Whoa, I'm telling you, they are fast. Okay, last question, and then Amanda's going to move on. Whoops, sorry, 2 questions, and then we're going to let her move on. First, from Kalinda McMickle, can you use it to purchase new construction townhomes?
In the sense that they're already finished, or?
I don't understand that either. Kalinda, clarify that while we ask her the next question from Allison Brown. Does the borrower provide initial comps and then the lender confirms what's submitted?
They can. On the rare occasion that my team comes back and says, hey, they said 250, we're coming in at 230. And I will touch in on this in a minute. And I'm at 70% maxed out LTV. Sometimes I'll be like, girl, if you got those 250s, bring them my way. Cause I want to beef up that higher. I want you bringing as little cash to close as possible. So I might ask for those, but initially we don't require them in the beginning. Because if we're seeing what you're seeing, then it's, it's there.
Okay. I will say that just personally, when I submit for these kind of loans, I always send them because it can't hurt. If they don't want to use them, they don't have to. And it might just help make your thing go faster. So that's just a personal. All right. So Kalinda has said, yes, she means like just a newly constructed townhome. Donna Kennard is asking, can you use it to buy land or lots with intent to build? Donna, she has already covered that. She said, you cannot just buy land, but if you you can get a construction loan if you are going to build immediately. So yes. And so that goes back, Amanda, to the new construction townhome. She meant newly constructed townhome.
Okay, perfect. So that kind of touches onto our DSCR loans. So I'm going to put a pin in that one because I'm going to speak to that when I talk about like burring and stuff and our long-term rental loans.
Okay, well, that's a great pivot point for you to move on to your next segment.
Right. Okay. So when you are talking to a hard money lender, you're going to have your rate. You're going to have origination points. which is different than points. If in a conventional loan, when we think of that, we think of like buying down our rate or taking a higher rate to get a credit or something like that. This is a little different. It's origination. It's, hey, the company needs to make some money for doing your loan. Can't fault them for that, right? So you have those two things. And then you have title and escrow, which can be pretty easily guesstimated. And then you're going to have any other fees that the lender is going to charge you. I only have a $9.95 doc fee. I have seen that doc fee in addition to lawyer fees, credit check fees, the wind blew north fee, you know, so just check those little fees out. They can be anywhere from $1,500 to $2,500. But you know, it just depends what lender you're working with, but they're fees to be familiar with and to look for in your contracts. Rates, yeah, they're higher. So you're not going to see like 2.99 on a fix and flip, but a 2.99 is going to be on a 30-year conventional that's going to have a 6-week escrow period with an appraisal and an inspection and contingencies and this and that and a lot of paperwork. Whereas, you know, I'll just use a round number. Even though I know this is competitive and I can be a little lower than this, like if you're at a 9.9%, it's an interest only loan for 6 months. And if you fix and flip in 2 months and sell your house, you know, that's a lot less money. It's not a principal, interest, tax, insurance payment like our mortgage payments are. It is interest only.
It's a cost to do in business that you would figure in when you go figure your rehab costs to begin with. That's the way I always look at it.
Right. And it's very similar. Like a lot of people are like, oh, you know, when's my first payment due? You do skip that month. You're always paying for the month behind you. So that's kind of a nice little buffer when you start your project. But yeah, the rates are higher, but it's just because this is a completely different structuring situation. And these loans are much higher risk because they're not backed by Fannie and Freddie. You know, like if you just like take off to Mexico one day, that's a risk that a private lender is taking to do your loan. And that's part of the risk assessment in it. So they're definitely competitive. Not everybody's at 16%. I would never take a loan that's like over 12, to be honest with you. I'm way lower than that myself, but I'm not in all the states. So, you know, they're comparable.
Y'all, mine was way lower than 12. So
I do know like what some other lenders like do. So I'll just put that out there, but
12% is pretty typical for hard money. For fix and flips, I think Amanda's going to talk later about some more longer term loans, but so we should be clear. We're talking about a fix and flip where you're going to buy, they're going to loan you not only the money to buy it, but the money to fix it up. That's what you typically think of as hard money. Typical rates for that are around 12. With this company, my rate was lower than that. I suspect that depends on your experience, but I think Amanda will also address some longer term loans with even better rates later. At least I hope she will.
Yeah, 100% will, because that'll talk about the townhomes too. So yeah, so those are kind of the fees and rates that you should be like kind of looking for and used to. If a hard money lender ever asks you for money up front, stop talking to them and walk away, because that's a scam. They should never, ever, ever ask you for money up front, even to run your credit. I personally don't even need to run credit until you're ready to move forward, because these are non-credit qualifying loans. So you know, that's even up to you. I know some of us are very sensitive about having like a check on our credit, you know, so just keep a lookout for that as well. You know, just never give anybody money unless like you're moving forward and it's the title company at closing.
And by the way, there are plenty of them out there. In fact, on the same very thread where I met Amanda on Facebook, there were a bunch of lenders in there posting that they can do these loans in a few days. And I talked to a couple of them, and several of them said, the first thing I always ask, because I don't trust anyone I meet on Facebook, it just so happened Amanda is one of the good ones, but the other ones I asked on that thread, do you have an upfront fee? And several of them said yes. So boom, immediately I just block them.
Yeah, that's just a scam. And you know, we all have to have our like the honest hard money lenders always kind of see those things, and we can't just be like liar, but You know, we know you're going to try to get $3,500 from them immediately. Any hooter. So when we're looking, this is super, super useful. So, you know, if you have a pen and pencil, like definitely write this down, because this is super essential in analyzing from your couch any deal that you're looking at before you even talk to a hard money lender. And that is the ratios that we use to decide what your loan amount is going to be. And that can help you realize how much your cash to close will be as well. Okay. So, top notch, universally, lender wide, very competitive, will be the 90% loan to cost, 70% loan to value ratio. Sometimes I do see a 75% pitch on the loan to value, but those people usually require appraisals. And obviously I could tell you 90% loan to value if I needed an appraisal, and then just blame the appraisal if it came in lower. So the norm that you will see is that 90 up to 90, 70. So I'm going to talk to the 90% first, because that's what we all want. That's the lowest. That's 10% down with closing. And that's going to be your purchase price plus your rehab cost. Okay. So that number, 90% of that is the loan amount that if we went with that ratio, that's the loan amount we would be using. Now, the other side of that coin is 70% loan to value, which is your ARV. So 70% of whatever your ARV is sitting right here. And these two numbers, whichever is lower, that's what the lender goes with. Okay. And the reason that's important is because obviously 10% plus closing, that's an easy thing to do in your head. But when you look at, if you happen to fall on the other end of that 70%, you can have more cash to close, because now you might have to, close a gap between the purchase price, this, that, and the other. So really look at those two numbers when you're looking at projects.
Could you give an example of that, Amanda? Let's say you have a house with an ARV of $200,000.
Yeah, I'm going to get out my calculator because I always like to just have it out here to do this. Yeah, so I want to write down too. Okay, say our purchase price is 100. And you're like, oh, it's not that bad, Amanda. I can put 25K into it. Perfect. Our loan to cost, LTC, is 125. Okay. And then I'm like, okay, how much do you think you can get for it when you sell it? What's your ARV? Oh, comps in the area are coming in at 200. Okay, so now I've got my 200. So I'm going to go over to my 125 loan to cost. I'm going to go 90% of that. I'm at 112,500. Then I'm going to come over to this 200 buddy over here. Going to look at 70% of that. Yeah, 140. Okay, so now it's like, okay, 112.5 and 140. I'm obviously going to go with the 112. It's lower than 140. So your loan amount would be 112.5. You would be bringing down the difference, which would be 10% of that loan amount. In my case, the way my company structures, it would be with the $995 doc fee, your origination points. They can range, I think the normal that you would see with any hard money lender would be anywhere between 2 to 4 points. You can think of that in your head as 2 to 4%. So 2 points times, 2% times that 112.5 would be your origination cost, plus the doc fee, and then your title and escrow. And then that's how much your cash to close would be.
Awesome. Thank you.
Yeah. Now, on the other side, I do want to give you one more example, because this one can kind of bite you in the tuchus sometimes. Let me see here. And I hate this one. I'm always trying to figure out how to not be this one. Okay, so say you're like, hey, Amanda, the ARV is looking, my margins are slim and my ARV is coming in at 150. Okay, so I've got an LTC of 125 and I have the 150 over here as my ARV. 70% of that, we're coming in at 105. Okay, so now my loan amount of 105 versus 112.5, I'm going to go with the 105. Okay, so now that means, well, that's actually not a very good example. I'm going to derail a little bit. Say it came in at 95. Okay, say that loan, that 70% of LTV came in at 95,000, but your purchase price is 100. That means you have to close that gap of the 5K plus your closing costs. So it can be a little more sometimes. So you just have to really see how the numbers play out. But I always tell everybody, you can totally sit at home and do that 90-70 split and see where you're probably going to line up on a loan amount compared to like your purchase price and rehab and all this, that, and the other. That's an essential little math thing to do. Are there any questions about that? Because I hate math. I can't believe I do math for a living because I just hated it when I was little.
There were no questions about that, but there were a couple that came in after you started talking again, which was, what is the reason for the credit check?
Oh, I just need to make sure you're not a terrorist.
Good, good. And what would it be for new construction? I'm not sure what that means. Althea, do you mean what would the rate be? I'm guessing she's asking what the rate would be, but she just said, what would it be for new construction?
Okay, so new construction, and I can actually segue into, I'll talk about construction new build stuff, and then I'll get into like burring into those 30-year rental ones, which we'll talk about the townhouses. So new build, always think like a lender. Don't think about yourself, because then you're just like super passionate about your feelings and stuff, and that just isn't going to work. Always think like the lender. And if someone came to you and said, I have a house that's in really bad shape and I'm going to make it really pretty and then make some money off of it, and it's kind of a no-brainer, I just need to like update the countertops and like put new doors and light fixtures and paint and maybe like new siding, and I'll be done. We're like, yeah, that sounds great. That sounds pretty easy. You're just going to walk in and take care of it. But then you show up and you're like, I found this land, and I want to build a 2-story house on it and like do the foundation and the framing and the plumbing and the electrical and this and this and this and this. And it's an up and coming town, and you tell me all this stuff. That's higher risk, especially if you've never done it before. That doesn't mean we're not going to take the loan, but you definitely need to approach that a little better. Now, the rates on that, because it's higher risk, are usually comparable to what you would have got with the fix and flip, anywhere from like 1% to 3% higher. Not the end of the world, but it's higher risk, you know? So there's something with that. I will say though, for the new build, and again, this is just how we structure our new build loans. I'm not, you know, every lender's a little different. Our new build loans are non-Dutch, which is a term not a lot of people know, but it basically means you're not paying interest on the entire like loan amount or what you're holding back for the build, for like build costs that you're drawing on. You're only paying interest on what you're drawing on. So that, even if, you know, it's a 11% opposed to like a 9% on a fix and flip, if you're not paying 11% on the entire amount that you need, it's only as you're drawing and going along, and that saves you money. So hopefully that's a little helpful. The builds, if you guys are thinking about building, I highly encourage it, because I mean, I feel like I've gotten 12 build applications in the last 3 days. It's been a little nuts. But you really have to approach it very thoroughly with the lender, especially if it's your first one. They want to know everything about the builder and who you're using. Like a track record, or unfortunately, I'm noticing a lot of builders don't have their own websites. I wish they did, but something like, hey, they built these other houses, here's the addresses and years they built them in this neighborhood, and they're currently building 2 others as well. Like, that's the kind of stability we want to see with the builder. And then we want to know, like, hey, have you talked to the city yet? Did you get any permits, like, kind of going? Do you have plans and blueprints? You need to explain it in such detail that we have no questions and we feel very secure with the build going up. So it's just a kind of about a little difference in those 2 loans. But again, they're short term. They're Like that one's the non-Dutch where it's kind of offset a little bit with the interest payments. No appraisal needed on that one. So even if you needed to demo a house and rebuild it, we're not going to appraise the old house that's there. No credit minimum, no pay stubs, stuff like that. So that's how they do require a survey. We would need a survey on that one though. Okay, so that's how the build loans can work out. I'm gonna jump into the long-term loans now with burring and DCR and turnkey versus burring and stuff like that. So the long-term rental loans, they feel more like a conventional loan because they're 30 years and they do require an appraisal. And they do have a minimum FICO of 660 on that one. Just because it's 30 years, you know, it's a little bit more of a commitment. But like when you work with a lender, we don't care if it's short-term or long-term, Airbnb versus long-term or whatnot, but some lenders might care. Some lenders don't offer short-term. So just make sure you check into that. And yeah, those rates are feeling more like investment property rates. Like I can speak to 3.9 to 5.9 on ours. Always look for seasoning conditions with a lender, especially if you're burring, because if you get a 6 month and you're done in 2 months and you want to refi it, there might be like a contingency with that you need to address with the lender. I know for us, it's like you can still do it, but it costs like 0.25% to the rate to do it earlier than expected or something like that, but you can still do it. Cashing out for the whole burr method is kind of like the ideal situation. You buy something real low, you build the equity into it, you refinance it, you cash out when you refinance it, and then you rent it. So speaking to what is, you know, pretty normal, 70-75% cash out is good to see. What I like is since you built the equity, you're not shelling out another 10% down. I haven't seen that yet. Is it possible to put more money down? Yeah, if the market were to like tank out of nowhere and the value isn't there. But I mean, you can always just sell the property if you wanted to and not rent it. But more times than not, you're not putting another down payment down and you're getting a check. So you're signing, you're getting a check for the equity, you know, up to 75% loan to value. And then you can start renting it out and you're in that like 4 to 6% range, which is completely comparable to what Fannie and Freddie would be offering you in a conventional loan. These loans, even though they feel, because they have like a more normal escrow period of like 4 to 6 weeks because of the appraisal, they're not income based. So we're not asking for taxes and, you know, pay stubs or anything like that. We're not really worried about your debt to income ratio or anything like that. We want to know how much money you can make each month off of rental. So when you start that process with that team, it's like, okay, what are the rental comps? Again, comps. Some lenders want you to have a renter in place. We don't need you to have a renter yet, but we just want to make sure that you're getting that 1% return. And if you are getting that 1% return, then the loan's pretty much good to go. And that's how that works for burring. Now, to speak to the townhouses, you can even use.
Move on to townhouses. Can I ask a question?
Yeah, absolutely.
I'm going to use a real world example. So I'm going to use my loan. So you loaned me $125,000 on a property in Wilmington that I already own. I paid for cash, $165,000. So I paid $165,000. You loaned me $125,000. I think I want to Airbnb it. So let's say when I'm ready, I come back to you for a burr loan. And first of all, how do you get the rates? I think Air DNA and that other one, forget what it's called. Karen might know the name of it. Anyway, they show, I think, $5,000 to $6,000 a month for short-term rental income. Is that what you look at? Or are you looking at ARV at that point if I'm gonna Airbnb it? And so what if that's the situation, if I paid $165,000 and I got a loan for $125,000, so I have $290,000 in it, and let's say ARV is 350 and estimated income is $5,000 a month, how is my BRRRR loan going to look?
So
Rabu. Thank you, Karen. Rabu, RABBU.
Yeah.
perfect. So I will speak to like Kathy, if you're like, Amanda, I'm done with the rehab, I'm ready to refi into the rental, I'd be like, cool, Kathy, here's Dan. And I would pass you on to the DSCR department. And the only reason we have a separate department is because these loans are a little more involved. Whereas like your and my loan, it was like, we had a processor added in and with title, and we did our little things, and then we were done. Those with the appraisal and whatnot, they have a different team that kind of spends a little more time with those. So since due to my conventional background, I can kind of speak to that department a little better. But when it comes to like super nitpicky things like that, I always like defer to them to speak more in depth about it, because I would never want to misspeak. I just know that when the reason they need the appraisal is the value does count into it, especially if you're doing cash out and refi, because you need to know how much you can cash out. But they're really looking for that 1% return against the loan and what you can get in for the rentals in that area. So that's their main focus in terms of deciding if that loan's going to pass or not.
And how do they determine that for a short-term rental? Do you know?
I think I've seen it's between, like, it's a seasonal thing. They look at the season between like a 6 to 9 month, because they do account for, if it is short-term, off seasons for specific areas. You know, if you're like in a vacation area or something, they do account for a certain span of like no rentals at all for a month or so. Whatever software they use to figure that out.
Okay. All right. There's a question from Joel Kenny. What affects where a long-term loan will be in that 4 to 6% range?
So if there's any seasoning that they need to consider, meaning if you're doing it like really quick after a fix and flip, because like I said, that I usually see that be like 0.25% addition. So say you like are like 820 credit, because that is a credit qualifying loan. We need a FICO of at least 660 or higher. Say you're at 815 and everything's looking really good and you're coming in at 3.9, but you came in under 6 months of seasoning for the fix and flip, it might be like 4.25. So credit is used on qualifying for that loan, seasoning consideration, and a little bit of history, kind of like risk assessment, like the other loans as well. But we are really competitive. Always remember, every lender is pretty much trying to earn your business. So they might have that range, but they're always trying to get you as low as possible.
Awesome.
Yeah. So the townhouses, and this is speaking to, oh, you're welcome, turnkey. Okay. Because sometimes people are like, I don't need to BRRRR. I just found this place that's like super cute and it's ready to go, and I just want to start getting renters in it. That's going to be a turnkey purchase, and that's going to be 80% loan to value. So you kind of, again, it feels like a regular conventional loan in that sense too, because it's 20% down. But it would be the same process with just the at least 20% down.
And credit based.
Yep. The only thing that really changes between needing to rehab the property, but because obviously if you do oh my gosh, I'm so sorry. Oh, my cat was scratching the couch. If you start with the fix and flip loan, it's a 2 loan process. You know, you're going 1 loan into the next loan, whereas turnkey is just you're in the 1 loan. So the only thing that really changes is down payment, because obviously with a fix and flip, you can be up to 90% loan to cost. Whereas a turnkey, if you're just walking into it, it's 80% loan to value. So little difference there. Does that answer the question about the townhouses? I want to make sure I get that one.
It seemed to, but if Kalinda, I think that was Kalinda's question. Yeah, Kalinda, if you want to let us know if that answered your question. Yeah, she said yes.
Awesome. Okay. So, touching on capital, because obviously when we all start, it's like, how much money do I need? Because, you know, sometimes we don't have 200 grand just hanging out. I always tell people it obviously depends on the loan size. But if you just kind of have it in your head that 10% plus your closing costs are available, plus padding, we do not want to zap all of your money at closing, because, which I will get into next, you do need to start funding the project before you can start pulling draws. Okay. So when I have someone who says, oh, I only want to show 25K capital, I'm like, no. I'm not going to take, I don't want to take all your money. I just want to know that you have as much as possible when we're done over here. So if you have 50, show me 50, that lowers your risk. That means, cool, you're only going to give me 20, but you're going to have 30 left over, and I'm funding your rehab. So that's just there for things that pop up, which make us feel a lot more comfortable lending to you, because not only do you have our money, but you have a little extra of your own. So, you know, a blanket 15 to 20% is just a good run of the mill to keep in your head. So you're not line itemizing everything, but so 15 to 20% of your project costs, if you have that available as liquid, a lender is going to be good to move forward with that. Any questions on that? No? Okay, cool. So that's how capital should look. Where you're getting the money, we're super flexible on that too. A conventional loan, it would be like, oh, if it's a gift, you need a letter of explanation in this form and that form and this and da. If you're like, hey, my mother-in-law just, you know, deposited some money for this, we're like, cool, that's fine. Hey, I'm JVing with my cousin, also cool. We just want to see statements. Hey, I'm using a HELOC or my 401k. That's totally fine too. We just need to see how much money is there to make sure you are able to draw it for your closing costs and stuff. So very flexible with where the money comes from. Just need to see it for proof of funds. And it doesn't need to be like 2 months worth of bank statements either. It's just like, what's in it right now.
That's incredible. Hey, Amanda, don't forget to put your contact info in the chat for everybody.
Oh, I will, for sure. Okay. And then the last thing I'm going to speak to are draws, because this is super important. And a lot of people think they understand it, because draws, you know, you're drawing from your money that you're financing. But you can get kind of shell-shocked during the closing process if you've never done it before and your lender doesn't speak to it because they assume you should know, which is like not cool. So I always talk to this to save everybody the headache of discovering this halfway through closing. Draws need to be considered, and this is a nationwide lender. Everyone is like, this is just how draws work. Think of it as a refund, okay? And the reason you get it on the back end and not the front end is if you bought a $50,000 house and your rehab was 70 and the ARV was 200, and then you said, Amanda, I need my rehab up front, and I gave you $70,000 on a $50,000 house, and then you took off to Mexico and we just never saw our money, that wouldn't work out for any lender. So we have to see completed work, which means once you're finished with your closing costs and finishing your loan up and putting a little bow on it, and you're going to start your project, you need to, and that's why we want to see padding in your account, you are going to front the cost of your project. So however you're doing that, whether it's with more liquid capital or lines of credit or however that is, and how you organize that with your contractors, whether it's all happening at once or you're having to wait for draws to replenish you to do the next one and the next one, that's something to be aware of, especially if you're tight on funds. You have to complete the project. So I'm going to use kitchen cabinets as an example. You have to buy the kitchen cabinets. Some people have to put down deposits for their contractors. The contractor installs the cabinets. And then you hit me up and you say, Amanda, I did the cabinets. Well, you don't hit me up, you hit the draws team. Although I always want to be CC'd on these things because I am OCD and I want to make sure everything works out really good. Hey, draws team, I did my cabinets and I need to get reimbursed so I can fund my next loan or at least get my money back. We say, okay, we're going to send an inspector out next day. Inspectors, that there is a fee for that with every lender. I haven't seen anybody be lower than me. We're 150. They can go up to 300. 150 is usually the norm though. The inspector will get out there in the next day or two, hopefully next day, takes a look at the cabinets, make sure they're not going to fall on anyone's head. Yep, they're installed, signs off on it, and then we can wire you those funds. So some lenders can take up to 3 weeks to do that. We take 3 to 5 business days. But that's how those work. So it's something to be super aware of before you start if you're doing it for the first time. Are there any questions on draws?
Seems everyone's good.
Okay, cool. So yeah, I mean, that
other questions about anything in general? Is that you're kind of at the end, right, Amanda?
yeah.
Okay. So
I
now
always
the chance to ask
more.
any question that you want. And while you're doing that, Amanda's going to put her contact information in the chat because after learning that you can go get a loan for your fix and flip, I'm going to assume that everyone on this call is going to go out and find a deal, and they're going to hit Amanda up for a fix and flip loan to get it done. Oh, here's a question. Okay. Are there any differences if it's a partnership or LLC versus individual? Great question, Freddie Woodard.
That is a good question. The answer to that is lender-based. For me personally and our company, we don't care if you go under entity, LLC, or a personal name. That's totally up to you, unless you live in the state of Georgia, because Georgia is going to tell you that they don't care what the lender thinks. The state needs you to be an entity. So if you live in Georgia, you guys got to be an entity, but anybody else, it doesn't matter.
And that's huge because there are a lot of lenders, hard money lenders that do require you to be an LLC. Okay, could you give another example of closing costs? So this is from Richard Floyd.
Sure. So I'll speak to ours first, and then what else you can kind of, what is normal to see in other lenders as well. You will see your different. So say you're 90% loan to cost, you'll see 10% down. And then in that closing cost on top of that, you're going to see a $9.95 doc fee, document processing fee. All lenders have doc fees. A lot of them are $9.95, oddly enough. You're going to see your origination points, which is that 2 to 4 point range. And that's a 2 to 4% of the loan amount reflected as the origination. And then you'll see escrow and title charges. North Carolina, I think you guys are like, those two together are usually like around 1,000 to 1,500.
In North Carolina, escrow and title is some states, for y'all who don't know, use title companies to do closings. In North Carolina, we use attorneys. So those fees are combined. Honestly, for a bank or TRID loan, those fees are around 1,000. For a loan with Amanda's company, a hard money loan, they should be actually less, probably more around, definitely under 1,000.
Cool. Yeah, that's right. North Carolina is with the lawyers.
The lawyers, which people think costs more, but it actually costs you less because what you don't realize is your title insurance is about 1/4 of what it is in other states. Okay, so a question from Sandra Murray. I was a few minutes late getting on. Do you loan in certain states or all states?
So I'm in certain states specifically. I can list those off if that's okay.
Yeah, absolutely.
Okay, I'm in California, Texas, Georgia, North Carolina, Ohio, Pennsylvania, and Colorado. I think that's 8. 1, 2.
Awesome.
Oh no, I'm missing one. Hold on. Who am I missing? Oh, Tennessee. I'm in Tennessee too.
Cool. Okay, great.
And you don't need to be in that state. I can lend on the property. So I have a lot of people who are in other states, but they're, flipping in Ohio. That's fine.
So it's based on where the property is, not where the borrower is.
Exactly.
All right. So Amanda has put her information in the chat. Everyone, please get it. She has her number and email there. And we're going to give you one last chance to ask questions before we thank Amanda and let you all go about your evening. Is from Allison Brown, is 15 to 20% liquid capital expected for all project types? Example of fix and flip versus turnkey. Oh yeah, see what she's saying.
So the turnkey purchases on those like DSCR rentals, if you were to just do turnkey, that would be an 80% loan to value, which would be 20% down plus closing costs. So that's pretty much every lender, even big banks. That's everybody, how everybody is with investment properties. So speaking to the fix and flip and the build loans, 15 to 20 is what I just say, so that you're just like you just know you're good on the capital. At the end of the day, it's project based. So if you came to me and you said, Amanda, that these are my projects, this is the numbers, I only have 12% capital, that could still fly depending on what the numbers are. You know, it doesn't need to be like 20%. But I just feel like as an overall encompassing, what should I have? 15 to 20 is like spot on perfect.
Okay, I got 3 more questions for you. Sean Dare is asking, do you require a bank account statement specifically for the LLC that is borrowing as an entity, or can use a personal statement?
You could use a personal statement, because even if you're going under an entity, you're still a guarantor. So for example, I had someone say, oh, well, I'm waiting for my LLC to finish so you can run its credit. And I was like, no, it doesn't work like that. You're the guarantor of the LLC, so I'm running your credit.
And there's always going to be the guarantor, right? Because Joel Kenny just asked that question.
Yes. So, and sometimes the LLCs can be under 2 people, you know, and then it's like, oh, are you both signing? Is just one of you signing? Because then that guy has to sign off on just you signing, and this, that, and the other. So just
that's
semantics.
a good question too. If you have 2 members in your LLC, you only require one as a guarantor?
The other one can sign off.
Okay.
They just fill out a form that says like, yeah, he's got it, I don't need to be there. I don't know if that's a state by state thing, but I know that I've closed loans like that. I just ask in the very beginning, I'm like, who is signing for this loan? Because nice. I need to get that lined up.
All right, Sheila Hatzer is asking, is there a minimum loan amount on a hard money loan as well as a BRRR loan, BRRR loan?
So yes, so that is lender specific. For us, on the long term, they want to be at 125 on those. So for the rental loans, they like to keep their loan amount at 125. For the build and fix flip loans, technically the company likes to stay over at 100 or higher. I encompass all of Ohio, and I don't know if you guys have ever looked at Ohio's real estate. You can get houses for like 10 G's out there. It's kind of crazy. So I've told my team, I'm like, guys, like property in Ohio is really inexpensive. So I need to be able to help more people, and this 100,000 isn't going to cut it. So I specifically can do loans that are between like 70 and 80 for people. So glad I'm talking here, because I can get them lower than 100.
So that also answered Richard Floyd's question as well as Sheila Hatcher. Okay, we're going to call it a wrap. Everyone, thank you for all your interest and all your really great questions. Good to see y'all so engaged. And I'm going to say it one more time. Now you got a lender, go get a deal, and then call Amanda. And Amanda, thank you so much. Y'all, let me just tell you that Amanda has told me she will travel to talk. So I'm trying to think, I'm just throwing this out there just to see if there's interest in it. I've been trying to think. Amanda's contact info, Judith, if you scroll up, she put it in. I'm gonna, Amanda, do you want to just put it in the chat again?
Sure, absolutely.
I will put it again, Judith. Everyone's saying thank you, but you guys, what if we had like a lender event, like, I don't know, Lender Palooza, where we had a bunch of lenders come in for a big meeting, and just let me know if you guys have an interest in that. I think it'd be something really cool. It's like all the money you could ever need in one room. Okay, yes. Oh, yeah, you guys like that. Thank you. Okay, cool. Amanda, I'll be in touch about that. She has put her contact in there again. So everybody, please get that down before we shut this meeting down. So it's Amanda at easystreetcap.com, and the phone number is 661-755-2182. Amanda, thank you again so much. This was awesome
guys.
information, and hopefully I'll be talking to you soon.
Absolutely. Have a good night, everybody.
Thank you, everyone. Kalinda, I'm going to put you my contact in the chat. Okay, I'm gonna give Kalinda a minute to write that down, and then I'll end the meeting. Thank you guys so much for being here.